And welcome to Lecture 10 of Section 3 in the course. This one we're going to talk about the two phases of price action, consolidation and trend, which once you understand this, you're going to be able to very quickly and effectively chunk a chart and be able to break price action down into its most simple form. So to start off, when we're going to define how price moves, we're going to start actually asking the questions, how do markets never move? And there's a couple examples I've listed here. We don't see any cataclysmic moves, especially in macro instruments where, say, the S&P 500 goes from 2,000 to 0 in a day. We'll never see something like 500 up days in a row where an asset is bid up again and again and again every single day for 500 straight days. And we never really see price that has zero movement for months and then all of a sudden drastically jump to another level. So if we know what markets don't look like, it helps us clue us in to what markets do look like and how they do move. So you can see in the E-mini S&P futures here, we have a few oscillations and some peaks and valleys and sort of an ebb and flow process. But we never see price do something crazy like trade here and then go down and trade here and all of a sudden rally back up in one day. We never see that in the markets at all. So that's going to help us define how they really move. And here's another chart in Bitcoin, kind of a similar structure, right? We have rallies, sort of an ebb and flow, wave-like formation with periods of inaction followed by periods of extreme action. But we don't have crazy things happening where every single bar is just up and up for days and days on end. So knowing, at least having a clue about how markets do not move, we can sort of define how they do move. And this mental model that we're going to implement here is going to talk about a transition period from two states: intense movement to equilibrium periods of little movement, waves and ebbs and flow. And we're going to call these two states consolidation and trend. So you can see on this chart here that it's very easy to point out areas of consolidation and trend, right? Obviously, this is a trend area, another trend area, and then we start to see a small consolidation area, little trend area here, and then here's a very, very large consolidation, and then a recent trend. Right, so if we take these two buckets, we can bucket most of price action into one of these two. And so during these consolidations, price is range bound and is not making any significant moves. It's just moving back and forth, oscillating around an equilibrium or a mean. That's because the market's in broad agreement on the current price, or the bull narrative or bear narrative is not consistently strong enough to push price in one direction for an extended amount of time. So here's an example of what that looks like in RBOB gasoline futures. Right, so despite the fact that at one point it's trading for 1.3 and then we go up to 1.65, in general, this market's hovering around a mean of about 1.45, and this is what equilibrium looks like. Okay, just prices oscillating back and forth. Same thing on euro. It's another oscillation period where we're finding a mean around 1.09, and prices are going above and below that mean, but they're just oscillating and oscillating and oscillating. So there's an agreement or an equilibrium established in this market's particular time. And then on the other hand, we have trends. When there's clear directional bias, markets are repricing. There's not equilibrium and agreement. It's moving to a new equilibrium and agreement. And we see this with very clear higher highs and higher lows in an uptrend, or lower lows and lower highs in a downtrend. So here are euro futures downtrending. And we can see it's very clear. It's continuing to make lower lows and then lower intermediate highs and lower lows. So this is a market that's not in equilibrium. It's repricing. It's changing to a new equilibrium point with a consistent directional bias. And here's another one to the upside. This is NVIDIA Corp. And it's very, very clear to see here that this is a trendy market and not a market in equilibrium. So here we have highs followed by higher lows at each step. And this forms a very clear upward biased trend. Now, that may seem pretty simple, but it's not easy. And the reason why it's not easy is because markets can be experiencing these two states simultaneously on different time frames. So they constantly are moving between these two states, consolidation and trend, on each time frame. And what makes it hard is when one time frame is moving on an equilibrium state while the other is trending, and they conflict with each other. For example, a trend on a daily chart could be in a move that's in the middle of a consolidation on a weekly chart. And that's why during the analysis process, we have to define the time frame. And that goes back to that multidimensional forecasting lecture we talked about, when it's important to qualify the time frame so we can also help qualify whether that time frame is consolidating or trending. Now, here's the example for you. So if you look at the E-mini S&P 500 futures here, and this is during the year of 2016, and you can see from early March to May, it looks like this market is trending, right? It's a very clear directional bias upward. We have higher lows and consistently higher highs. But if we take that same time period, that March to summer time period, right around here, we can see that, yes, on the daily it trended, but on the weekly time frame, maybe it's just part of a huge consolidation range, which we could outline as so. So price could be oscillating in this huge range on the weekly, yet trend on the daily. So from a weekly perspective, we're in an equilibrium or consolidation. From a daily perspective, we have a trend. And that's what makes this stuff difficult, is we can have different states on different time frames that conflict with each other. So another concept that we want to distill into us is thinking about consolidations and trends from an emotional perspective, like we talked about with the emotional narrative of the head and shoulders and other patterns. So what we tend to see is larger consolidations equal longer trends. And why that's the case comes from this emotional insight. So think about what a consolidation is. It's a place where a lot of people are getting frustrated. And in the game of asset speculation, people want movement, right or wrong. And if they're in an equilibrium state and they're caught in there, no one's right, no one's wrong, everyone's staying stagnant. And no one likes to sit around and spin their wheels as well. In the market, the job is to consistently produce returns, not tread water sideways. So the longer the consolidation, the more people are caught up into this particular trade emotionally, the more amount of time the people have invested in a particular theme. And so when it breaks, there's going to be a lot more buying or selling pressure because so many more people are involved. So a little break on a 5-minute chart is just a blip on the radar because there's not many investors involved there versus a huge weekly or daily break. And you can see in this example on E-mini futures, is the daily chart, we had a consolidation range that was around 107 points wide. And once that broke down, it led to a move that lasted about 168 points. And here is emerging markets on a larger time scale weekly. So you could see this consolidation was multi-year from 2012 all the way till mid-2015. Investors were frustrated in this, right? No one made money. It kept oscillating up and down, and virtually went sideways and was around a 9-point range. So when the market finally broke, we had so many longs built up in this that were wrong. They liquidated their stuff as soon as possible, and we had a very similar sell-off. So that's why the width of the consolidations tend to equal the length of the subsequent trend in the market. It has to do with this emotional concept of more investors getting caught up in longer consolidations. So as a directional trader, we want to avoid consolidations altogether. They're the bane of our existence. We do not want to be involved in consolidations as a directional trader, because in a consolidation, there is no bias in price. And there's no rhyme or reason to the daily ups and downs in consolidations because we're in an equilibrium state. So price is just kind of bouncing around haphazardly. Well, obviously, if you're betting on direction, you're just going to get frustrated because there's no clear direction. The market is, if you were to take the noise and fluctuations out, just moving straight sideways. So they are a waste of both financial and emotional capital sitting into these oscillating equilibrium consolidation periods. And you're going to look like this if you're sitting into those types of consolidations, just getting bumped around by fluctuations of other people also getting frustrated with no directional bias present. So if we take a look at Harmony gold mining in this scenario, we don't want to be in this market. We just see a bunch of consolidation. The market is trading at 317 in November here, the same price it was trading in March of the same year. So this is frustrating a lot of people as neither bulls or bears are making any money. And PTJ always talked about this as well. He says, always look for a trending market. As a directional trader, we do not want to be sitting into these consolidation zones that are going to cause, just frustration and no forward progress. Instead, we want to focus on the trends. And because trends have a clear directional bias, and we want to hop on those trends as soon as possible and ride them for as long as possible. And continuously repeating this process over and over again is searching where the next trend's going to be and riding it for as long as we can is really what global macro trading is in a nutshell. So if any type of directional trader is looking for a directional bias in the market, usually in the form of a trend, and trying to ride it for as long as they possibly can. So now here's the exact same graph we looked at earlier of Harmony Gold Mining, and this is the same price, 317 that we were looking at in November. That was virtually the same in March. But now look at how much different it was behaving earlier in the year. So we have a clear directional bias during this time period in the market for HMY, and this is the stuff that we want to be hitting and we want to be exposed to. And when we see indications that consolidation is going to occur, we want to cut our positions up. So another thing that's great about the market is that we tend to oscillate in between consolidation and trend. So periods of consolidation tend to lead to periods of trending, and periods of trending tend to lead to periods of consolidation. And so knowing this relationship, this ebb and flow between these two states of the market is going to be a key critical component to timing moves. And we're going to talk a lot more about that as we progress here in the course. So another thing to keep in mind too, and a good rule of thumb, is that markets for the most part do consolidate. They are in equilibrium. They're just bouncing back and forth, frustrating you around 85% of the time. And they're going to only trend about 15% of the time. And these numbers might even be more skewed depending on the year. So this is also consistent with our Sturgeon's Law concept again, where 90% of everything is crap in the markets. And most of that crap's consolidation and noise and price just bopping back and forth and doing nothing. That 10% of the time is when we're going to get nice, clear, directionally biased trends and are the ones that we're really going to want to ride. And this is a reason why the P&L distributions among directional traders are skewed into this 90-10 fashion, because most of the moves end up being false moves or fizzle out or don't end up being very large moves. Only a small percentage of them, 15 to 10% of them, actually have those nice big trends. So most of a year's profits are going to come from a handful of those themes that have real trends. The rest are false breakouts, frustration points, more consolidation, forcing small losses on everyone. So next time you look at the market, really try to find this, really try to internalize this and check for the consolidations and the trends and align yourself with an area of the market that's moving, not something that's bopping around randomly.